Welcome to Market Week in Review for the week ending November 19th, 2021. I'm Sophie Antal-Gilbert, and I'm joined today by my colleague Eric Ristebin, Chief Investment Strategist for Russell Investments. Good morning, Eric. How are you?
Good morning, Sophie. I'm great. And you?
Very good, thank you.
Good.
So it's actually been quite a quiet week this week, Eric. So I'm hoping that your comments today will help reflect that and keep it that way, especially as in the US, at least we're heading into a holiday week next week. But I'd be curious to hear what caught your eye. A couple of things that maybe are sort of bubbling a little bit under the surface that I was hoping we could get your perspective on are inflation. Is it inflation? Is it hyperinflation? How worried should we be? The second one is about legislation that was passed in the US. And then the third topic around COVID and sort of reemergence of COVID in Europe and restrictions. How much of a market risk do you think that is? So those are sort of three things that I was hoping we could get your perspective on.
Unfortunately, none of them are new. They're just continuations of debates.
I know, exactly. It's sort of like, what's the next installment? So over to you. Maybe if we start with, is it inflation? Is it hyperinflation? Should we be anxious?
Yeah, well, first of all, it's not hyperinflation, So ask the countries that have experienced hyperinflation when you got wheelbarrows of cash to get a loaf of bread. It's not that. But is it inflation that's going to persist is really the question. We saw basically a 30-year high. I think it's a 31-year high technically in the latest inflation number that we saw last week at 5.4% in the U.S. We saw some numbers out of Europe. The Eurozone was 4.2. That's a decade high. And we saw a similar number, I think 4.1 in the UK. So, and that's, if you think about it, the inflation target of most of the central banks is around 2%. So that's north of 2%. So the question becomes, are natural forces in terms of supply and demand, some of the supply chain networks that we're having, difficulties that we're having, do those work themselves out? The other thing is economic growth. The rate of growth is still strong, but it is slowing. So maybe you're going to have a kind of adjustments on both the supply and the demand side. Maybe demand drops a little bit as economic growth moderates and supply comes online. We still think that is the likely outcome in kind of a 12-month horizon. We do see inflation moving out of the system, or at least at this level out of the system over the next year. But that debate is going to continue because we keep seeing these prints in high inflation numbers. I think the market, you talked about being a quiet week. The MSCI World Index is up. I think it's up 11 basis points, right? So for the week. So
we'll take it, but yes.
Yeah. So I mean that's as close to nothing happened as you're going to get in equity markets, and I think the U.S. Treasury yields and yields generally are right there with them. They didn't do much either. Little volatility in the Treasury market in the middle of the week, but nothing really to speak of. So I think on the other side of the equation, we saw two really good manufacturing surveys. The Empire State survey was actually stronger than expected. The Philadelphia manufacturing survey in the U.S. was stronger than expected. Retail sales in the U.S., even though inflation's hitting, consumers are still spending. That was actually stronger at 1.7% than expected. So that's it's the push me, pull you of the market that's going on right now that, worries about inflation, what that might mean for the Fed, what that might mean in the longer term monetary policy and to the economy, but then reasonably strong economic data in the present.
So if that is inflation, and it's inflation, not hyperinflation, got it. What about legislation in the US? Congress has been busy. Where are we at?
Well, so President Biden signed the bipartisan infrastructure bill on Monday. That was passed earlier by Congress. The headline was 1.2 trillion. The incremental amount was 550 billion. Some of that stuff is already in kind of the cake, but and that one's broadly on the cellular phone networks. It's just infrastructure, and I don't think there's anybody really on the side that we don't need to fix our roads and we don't need to upgrade our power systems. So I think that's probably a positive for the economy, although a relatively modest one because that will be spent over a number of years. The House did this week pass the legislation today, actually, and after a delay, about a $1.6 trillion package on that Build Back Better plan. So the House did that today. The Senate is expected to vote in December. It is very far from clear whether that can pass, and I think I would So I would say that its current structure is probably not going to be what comes back from the Senate if they can successfully get effectively Senators Manchin and Sinema to vote for it, because they have yet to say that they're going to vote for this package. And again, I think contextually, it's important to understand that that's 1.6 trillion right now in size over the next, basically the next decade. So, it is accretive to economic activity and economic growth, but it isn't, it's dwarfed by the packages that we saw in the teeth of the COVID crisis. So it'll be positive generally for economic activity in terms of fiscal stimulus, but it's probably not the headline number for people to focus on.
Okay, that's helpful. You mentioned COVID just now. COVID is sort of rearing its head in Europe and causing some of the countries to reimpose new restrictions. What is your sense on the impact to the markets, and what Europe does? Is the US going to follow suit, or what should we be expecting as investors?
Yeah, well, first of all, the kind of resurgence of COVID in terms of infection rates isn't just Europe. The US is having the same thing. I think we're on the last 14 days, I think we're up 14%, something like that. It's actually, now we're not seeing hospitalizations and deaths move up at the same level. And that's probably, well, that is vaccinations primarily. But I think in the US, it seems fairly clear at this point, no major lockdowns are likely to occur in the US. I think there's not the social or political will in the country to lock down the economy. The European governments seem a little bit more willing to do that than the US, although I think their willingness is probably is waning as you go through time. If you think about kind of what we are looking at in terms of the risks of the global economy right now, I think it's probably inflation and China and what's happening in, the slowdown that we're seeing in China, and what direction does that go? Does that kind of hit our expectations, or is it worse than we expect? Those are probably number 1 and 2 in macroeconomic risks, with COVID probably being third, because what we've seen is, in the summer of the Delta variant, we didn't see anywhere near the kind of hit on the economy. It obviously was a headwind, but it wasn't enough to actually take the growth rate to negative and or even away from strongly positive. So I think if you're thinking about things for market purposes, unless something changes with the virus itself, there's another mutation. But right now, I think it's inflation, China, and then COVID.
Terrific. Well, we have come a far, far way in the past year. I think a year ago at this time, that is not how we were ordering sort of risks to the market. So thank you so much, Eric, for sharing your perspective and your insights. And thank you for joining us. We'll be back again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.